So good morning to all of you from Brussels. It's a great pleasure to have you for this online event presenting our flagship publication, the EMF Hypostat. I think it's a very important moment. We wanted to make this conference today because today is also the day when the new European Commission is taking office, actually next Monday. Has been voted last Wednesday in Strasbourg, and it was a bumpy road, we have to say. We see that we are a new completely political situation where majority can move. The vote of the Commission of yesterday is different from the vote that we have seen in July, and we have seen a shifting of majority with different political party supporting the European Commission in different ways. What does it mean? It means that our role of advocacy will become more and more important because also in the pipeline of this European Commission, we have extremely important dossier impacting our industry. First and foremost, housing, but all the financial services and also energy. And we are becoming more and more crucial also for topics and issues which were considered very far away from our sector, for example, immigration, and also we are becoming larger and larger in our scope of action, having a very global nature. Our ISMAN network is providing information and data from all over the world, from Mongolia, Malaysia, Japan, Brazil, and Canada. And we are really becoming a global think tank to allow housing to be more financial stability oriented, more efficient, and give to the European citizens, but the global citizens, the hope to have a better future, which is the leitmotif of the former Commission, the next generation, and is still the leitmotif of this Commission. Well, the difference between the previous von der Leyen Commission and this von der Leyen Commission is probably the Mario Draghi report, which is calling for improving competitiveness in our market, and we, as capital markets provider, are the center of the competitiveness. We want to have an efficient housing market relying on capital markets where banks, lenders can support families in making their most important investment in their life. We are still with this plan and our community is becoming bigger and we cover the entire value chain from retail activities to capital markets activities, funding, and then in between, we cover all the actors playing an important role in innovation and making this industry stronger and more robust. For example, system providers, for example, rating agency, investment banks, who are really the essential blood giving energy to this market. We represent all of them at European level, but at the global level, as I just said. Can we make the difference? It's important the work that we do. I think so. I would like to name few things that happened in the last month where our community working together, united, and with sense of the community was able to make the difference. First and foremost, during COVID, the few weeks where actually COVID started to become a real emergency, our community was able to take action immediately to be in contact with the European Commission, and we were able to relieve millions of the European citizens from the monthly payment of mortgages by creating a coordinated action at the European level to relieve and support the European economy. Without this action, I think that probably the recovery from COVID will not have been possible. The mortgage business in Europe at that time was counting 47% of the GDP. So our coordinated action made a real macroeconomic difference and supported the recovery of the European economy. On top of this, the good work done by all of us over the last 20 years, where we believed in the banking union, we believed in capital markets union, and we have supported and integrated the banking union in all 27, at the time 28 countries of the European Union. We have supported capital market access, and we have reduced the reliance on deposits, making the financial stability of our union stronger and ready to react. That was critical when, unfortunately, the aggression of Russia to Ukraine appeared clear, and all the countries in that region were suffering from geopolitical crisis, and they needed to access capital markets. our knowledge, our best practice, our legislative framework help those markets to have easy and robust access to capital markets with a solid crisis management tool, which is called covered bonds, or Pfandbriefe, or Realkredit, or Obbligazione Foncière, or Obbligazione Bancaria Garantita. The market was ready to resist to a crisis and be ready to do this on efficiency without using taxpayer money, because our market was able to support the economy by using only capital markets resources. That's the added value. That's where we can give a contribution to the union. On top of this, our good work over the years has allowed to finance the mortgage industry with a solid instrument, as I said, covered bonds, but also securitization. We have just published a few minutes ago our securitization response. I'm very proud that we are among the first federation to have a consensual paper. It was a difficult one. We have always achieved a strong compromise. We have listened all the voice around the market, and we were able always to build a compromise and to respond with one single voice, as is our tradition. But I would like to say other things about how our industry has helped and supported the European citizens. We have strong initiatives like the Energy Efficiency Mortgage Initiative, which is positioning our 2,000 banks in a very constructive way, telling to the European Commission and to the broad audience that we are here ready to help, to support citizens in supporting the transition economy. This is true for mortgages, but we want to do more. As discussed in our last board meeting in Naples, we want to produce public sector support with public cover bonds. We want to support the small and medium enterprises with the European secured notes, which is an amazing idea to provide a capital market instrument ready to support the businesses that are supporting the transition economy. Our industry was able also to defend the disposable income of families over the high inflation period. Millions of European families had access to cheap mortgages and fixed rate mortgages. During the COVID crisis, most of the markets were using fixed rate mortgages, which was an important source. And after COVID, with the inflation rising in all the markets, most of the families have been shielded from high inflation because the most important expenses of the month, housing, was frozen and was protected with the fixed rate mortgages. So we have provided real cash to the European families by defending and avoiding NPLs in the mortgage market. This is a coordinated action which has been done by all our industry, working together, hands in hands, finding always a solution. That's the spirit of the European Mortgage Federation and the European Covered Bond Council, and now of ISMA with a global ambition. Today, I'm very honored to present you the Hypostat publication, which is once again giving a complete pictures of the mortgage market. It's very useful. It's very useful because this can destroy legends or fake information that are disclosed in Brussels by other think tanks saying that the mortgage industry is not supporting the real economy. And no, we have been supporting the real economy with a strong and I would say coordinated action, a consensual action. What is magic of this industry is that we have transformed a national item and the national housing market in a very international opportunity. When we have designed at European level directive, very important directive like the Mortgage Credit Directive, the Covered Bond Directive, we have been able to respect the national tradition, but take advantage of the global opportunities of financial markets. When we have all the Canadian banks issuing covered bonds, all the Singaporean banks issuing covered bonds, all the Japanese banks using covered bonds, we have built something important. We have geopolitically positioned the banking union and the capital markets union as a benchmark for other countries. We are doing the same in emerging markets now, and today we will try to grasp this kind of magic touch that we have been able to build in the last 20 years. I'm very honored that the first speaker will be Yula. He is the chairperson of our Data and Research Committee, which is our think tank. And I would like to extend the deepest gratitude of our organization to all the people who have been involved in the collection of data. Every year, we are able to produce real numbers, which is the official source for the mortgage market. There are no other organization able to compete with the quality of the data that we produce. And I invite all the Brussels discussions to look at our source. If you say that in Europe there are no fixed rate mortgages and consumers are exposed, look our numbers. You will see how many fixed rate mortgages and how many families have been protected by high inflation because of the construction of covered bonds, which are allowing banks to finance mortgages long-term on their balance sheet. That's what we have been built, real support to the macroeconomic of the Union. Yula will be giving an overview of what is the shape of the covered bond market, and we invite all of you to raise questions to Yula to see what is available. We have also improved our way to communicate. We have the Hypostat, which is available online. You can download it. You can flip the pages online very easily. Or if you want, we have created also a database that you can go there and you can check the data straight on the database. So this is all available on our website, and we are very keen to have your comments to see how we can improve, how we can more comfortable and more useful to you, and you can get data in a more comfortable way. Today also, we will present a few key themes. Normally in the Hypostat, we always try to capture themes which are important for the year. And we have a committee reflecting on this, and we have amazing authors. I have to say, I mean, the most relevant speakers and authors into the market, it's an honor for us to have you on board with us and sharing the views of the market in different corners, commercial real estate, globalization, ESG. It's a fundamental element for us to give the importance of the dialogue in this community and also to position ourselves in the political debate, which will be, I think, topical in the next 5 years, how to position housing. So today we ask Data Warehouse to support us. Usman, thank you very much for being with us. I mean, the impact of energy efficiency, the EPC, this strange acronym, the Energy Performance Certification, is a fundamental data for lenders, for our banks when they have to calculate the GAR, the Green Asset Ratio, and it's changing the IT world of our banks, the compliance world of our banks, the supervisory aspect. So access to data is a fundamental element for our industry, and we want to be there. We ask, you will see quite few rating agencies. Thank you very much to Fitch and Moody's to be with us, because they are our eyes. They help us in understanding where the market is doing. So, I mean, thank you very much to have the, I will say, overview from Fitch. And Susan and Davide, thank you very much for being co-author in this article. Alexander, you were the difficult one. We put you on the spotlight with the most difficult topic. Everyone was calling us and asking what is happening on the commercial real estate. Well, we asked, let's ask Alex. I mean, he's the best guy, and we ask you to write a nice article. Thank you very much for this. And then we have Antonio and Marta, who wrote a very nice chapter on covered bonds and capital markets development, CMU, or it's the debate of the next mandate of the European Commission, how we can make Europe more, I think, important also for external stakeholders in emerging markets. Well, I'm sure that if you read the chapter of Antonio and Marta, you will be inspired and you will find a solution. At the end, we will conclude this kind of session with few question and answer, and really invite you to reflect about questions, and our author will be more than happy to answer to you. With this, I would like to thank you for being with us. Thank you for all the good work that we are doing behind the scenes. I think that as a community, as a group, as a team, we have been able to make the difference several occasions, probably saving Europe from another crisis. Thank you all, and it's my honor to give the floor to Yula for making the first presentation. Thank you all.
Thank you very much, Luca, and good morning and welcome to everyone. I am really honored to be in such company of such distinguished presenters also from the rating agencies. So a few words about our Data and Research Committee. we are behind the Hypostat, but we also issue on a quarterly basis the reports, because this Hypostat will cover mostly the year 2023, and we will see also the first market movements in 2024. But this is a very good snapshot on the mortgage markets of Europe, which is not an easy task. I am on my normal job is to work in a mortgage bank, and so I work with both sides, mortgages and also covered bonds. And I have to say that covered bonds are becoming really a more similar instrument in most of the countries. We have the European Covered Bond Directive, so we are really going in one direction. Of course, because covered bond is a very important capital market instrument, and it's very important for the investors to have the same standard. Covered bonds are becoming more and more alike. Why I speak about this? Because the same thing cannot be said about the mortgage market. So Europe is very diverse. Mortgage markets are very much differing from each other. And although we have a mortgage directive, but we see things happening on different directions on the different European markets. So we can go now a little bit to the figures, but time is very short, so I will give only a snapshot, so I won't go into the details. Maybe like Luca gave a very high-level overview, I try to go a little bit more in the details, but of course we could speak more hours about the mortgage market, so I will take only a few aspects of the mortgage markets to show what was the most characteristic for the year 2023. So I think for the development of the mortgage markets, there are many economic influencing factors, but maybe I pick two of them, what are the most important, the quarterly, or you can see on the chart, the GDP change. The other is the unemployment rate in Europe. And when we also analyze long-term trends, I had seen it in some studies that GDP and also house prices have a close correlation. But let's look at the GDP changes. So we have some decline and stagnation in 2023 as far as GDP is concerned. Good news that in 2024 we see some positive movements. If we look at the different regions, we can say that Northern Europe is more moderate in growth. The most volatile is Western and Eastern Europe. You have seen some ups and downs. And if we just look at the numbers, Southern Europe had the highest volatility in GDP growth rates, but always they were positive.
Sorry, if you're sharing slides, I cannot see them. Maybe it's just me, but
that's strange.
No,
I see them.
No,
but
I see them.
I see this.
Now.
I see.
Now,
Right.
yeah.
Excellent. Okay.
I think it's the type of view that you have.
Okay, sorry for that. I'll try to change. I saw them for a second. Well,
Okay.
let me work it out. I
Yeah.
see them now. Yes.
Okay.
Yeah,
Sorry.
they just appeared for me, so.
Me too.
So everyone sees the slides?
Yes.
Yes,
Now,
now,
yes.
yes.
Okay.
Yes.
Okay. Thank you. So on the right bottom part, I am sorry because maybe also I don't know if you look at how big is your screen. It's some of the numbers are too small, or there is too much information. Anyway, we can see the tendency, and the tendency in unemployment is that going back a little bit in time, so in more than 10 years period, unemployment rates have gone down. Nevertheless, the highest unemployment is in some of the southern countries like Spain and Greece has still last year more than 11%, and Greece, I think, 12%. And the smallest unemployment was in Germany, and it's interesting also Poland was among those countries with 2.8%. Let's go to the next slide. So this topic is important from the mortgage market. Luca was mentioning at the beginning that housing is a key issue for the families in Europe and for the first-time buyers. So it's very important how house prices are growing. And house prices have been on steady growth in most of the countries, but 2023, there were 8 countries where the house price index has fallen, and in 18 countries where it increased. Largest falls were in Luxembourg and also in Germany. It's interesting because for me, Germany was one of the most stable mortgage market for many years. Finland, there was also a negative figure with 4.5%. And the biggest growth, you see it on the left side, this is the year-on-year changes. The biggest growth was in some of the eastern countries like Poland, 13%, Bulgaria, 10%, and also Croatia, close to 10%. And then if we look at the next slide, we, in the Data and Research Committee, analyze not only the national housing markets, but also it's important to see how big cities and capital city house prices are behaving. It's also interesting when we look at this changing of the trend. So in the crisis period, when a housing crisis is starting, it happened in 2007, 2008. The first sites were showing not on the national market, but maybe on the capital market and the capital house price market. And the other thing, that prices have skyrocketed in some of the big cities. So it's what also Luca mentioned for the housing affordability. It's also a question which we have to deal with it, because we are giving a tool for the families to get their first house, be it a mortgage or there are some other methods also. So we normally investigate the countries, and there are some adverse effects, like in Italy, prices in Rome have moved in an opposite direction than the country itself. In Madrid and Helsinki, we have seen capital city housing prices going above the national average. In Finland, this was really impressive. And then there is of course, Paris is a very special city. So in France, for a long time, the house price index of Paris has surpassed the national average, but then there was a change and it went a bit below the national price growth. We have to say that, of course, who is dealing with house price indexes, this is, of course, a difficult issue, because in cities, prices are much higher. So national average represents average house prices, and in the city, especially in the downtown areas, the prices are much more on the top. And when there is a change on the market, that affects differently the countryside and the cities of the different countries. So let's go to the next slide. We cannot go into all the aspects of the mortgage market, but one thing is very important. building permits and housing completions. And in my presentation, I will not speak about the sustainability and green topic, but maybe at this slide, I have to say that if we want to reach the very ambitious goals of the EU, simply with building new houses, it will take us 150 to 200 years to change the housing stock. So very big part of the housing stock is obsolete from energy performance point of view. Nevertheless, the new houses, they comply with the latest energy requirement. But in most countries, this is between 1 and 1.5% renewal rate of the total housing stock on a yearly basis. Nevertheless, this is an important part of the mortgage sector. So what we see here, that housing completions have increased steadily, but we see over the completions, the building permits, which is from 2021 is going down. So it means that there might be some problem with the future projections of the building sector. Maybe we can see a little bit later some of the aspects. Of course, high mortgage rates are not helping the industry, and that's what Luca mentioned, and I will show also some slides a bit later. So Eva, please, let's go to the next slide. This shows the volatility, and it's also interesting country by country that the highest growth in new building permits issued was in Greece and Portugal, and the negative trends are characteristic for most of the countries, but developed market like Sweden also, there are less new building permits issued. Okay. This is a 10 years period, so from 2013 to 2023. Okay, let's see the next slide. Yes, this is the ownership and the financing of the homes in the EU countries. So first of all, there are country groups, and because I am from Central Eastern Europe, maybe I start with my group. So we have a very high ownership rate in Hungary, but the highest ownership rate is in Romania. Then comes, I think, Bulgaria and Croatia. And this is very typical that in our countries, people own their houses. And another thing that you can see from the chart, that the penetration of mortgage is relatively low. And there are the other countries, and this always poses me the question, the very developed markets like Germany or Denmark or the Netherlands, the ownership proportion is smaller, and people rent their houses. So I always ask myself, what is the future trend and what is good for the families when they start, young families or young couples, when they start a new life, to rent or to own a house. And I think that there can be arguments in both directions, because that's very good to own your flat. It gives you an asset for your next life, but then you are a little bit linked to the place. And today in Europe, people are moving from one country to other, especially young people. So this is also a question that we can pose, that many people think that maybe the renting is the solution. For other families, like it is mentioned also in our study, renting is simply the only possibility to have a housing because they cannot afford to have their own house or their own flat. And I have to mention also that in some countries, owning a own flat, it's also an investment for the future. It's also an asset, or it's also covers you for the last part of your life. Also, when the pension system is not solving your long-term financial plans, so house and mortgages really can be seen from different topics. But one thing is sure, and I will come to it later, that given the present higher interest rates, it is becoming more difficult to get your first home if you are an individual or a family starting your life. Okay, so we can go to the interest rate topic. There are very clear signs that after a long and from the mortgage industry point of view, very, I would say, golden time when interest rates have been really helping people to get their mortgages. We have a quite drastic change. It's 2021. You can see it very clearly. So on the left side, you see the policy rates for the central banks, also Federal Reserve. So this is a global trend. It's not Europe. It's a global trend that interest rates have risen. And then the country average. It's also important to say that Eastern European mortgage markets have higher average rates, so it is almost 6%. This is on the, if you look at the right side of the slide, so Eastern Europe has high mortgage rates. Western Europe is also high compared to the earlier, or Northern and Western Europe compared to earlier mortgage rates, but it's still in the area of 3-4%. Okay, so let's go one slide further. Oh, okay, I am sorry. I wanted to speak. Eva, can we go back, because there was if I remember, there was a slide with variable and fixed interest rate. Maybe if we have it still. If not, I will just speak about it. Okay, yeah, sorry, then I can, let's speak about, because it's important, like Luca mentioned as well, that we work hand in hand in close cooperation with the covered bond section, and countries where we have a very long tradition of mortgage finance through covered bond typically had fixed rates like Germany, Denmark, and countries like UK or Ireland, where the mortgage financing was on different foundations. They liked, yes, this is the slide. I'm sorry, because this slide was maybe taken out from the presentation. Yeah, so what we can see today, as Luca mentioned, that with the relatively high interest rates, the variable rates are becoming also typical for some of the countries. Without going very much into the details, this is also one thing where I don't think that in the future we will see the same thing for EU countries. So I think that there are national traditions, there are also traditions in the financing. And also I have to say that with the present relatively high interest rate environment, the variable interest rate have become interesting also, again, for some markets. In Hungary, for example, in the last 3 years, we had almost 100% fixed rate mortgages. And since it started before the increase of the mortgage rates, it was good for those debtors who took fixed rate mortgages. Of course, when we are now in a different situation, we see also variable rates coming back to the mortgage products offered by the banks. So due to time constraint, I am sorry just going too fast with the slides, but I just wanted to give a snapshot about the market. So we can say that 2023 was maybe not the best year for the mortgage industry, but this gives us even more stimulus to work on solutions to help the customers and debtors and to help the citizens of the European Union. Thank you very much. And if you will have questions afterwards, I am ready to answer.
Thank you very much, Yula. And also allow me to say that you have been an important element also of the OFINET Advisory Council, where we try to reproduce and duplicate what we are doing here for Hypostat at a global level. So we are really trying to have this ambitious project or ambitious dream to create a global database for mortgages, which can support action of the World Bank, IFC, Asian Development Bank, African Development Bank, EBRD in supporting housing markets, which is a crucial thing. And we are using the approach that we have been using in Hypostat to duplicate this in other countries. So thank you very much, Yula, for your presentation. And now allow us to dip more on key topics. ESG is for sure one of the most important one. And thank you very much to European Data Warehouse, Usman in particular, to give us this overview about the energy efficiency relevance in the credit. Usman, can I give you the floor?
Thank you so much, Luca, and thanks everyone for your time. Luca, I really like that how you mentioned that mortgages are clearly one of the most important financial decisions that a typical family makes in Europe. And I think it puts a very good perspective on how important the work that we do is, and of course, how real it is. And I think similarly, another thing that's clearly very real for us in these days is the climate impact. And of course, this is something it's like makes it even more important because the houses and the energy efficiency and how much of an impact on indirectly they can have on the climate. So of course, it's like makes it even more important, the mortgage industry, and how, of course, we can work with it. So we had this article, is energy efficiency relevant, credit relevant when it comes to mortgages? And I think it's a very good, we came up, it was quite data intensive, of course, as it is always with this kind of work. But I think the result is quite clear. And I think kind of a win-win situation puts us in a good position in a way that clearly we see that the more energy efficient a property is, the more likely the borrower is to successfully keep on making mortgage payments. So of course that is a win-win situation going forward as we need more and more energy efficient houses. As I think Guila, I'm sorry if I don't say the name properly, you just pointed out that of course if you keep on relying on new stock of houses or the new permissions for new houses built, it's going to take a very long time to reach that goal. So of course it's a very challenging task as well, but luckily one thing that will we believe goes in favor is having an energy efficient property is more economical for the borrower who borrows who gets a mortgage. So at least this is the positive, which should hopefully encourage a lot more people when they make their important decision in life and financing a property that they go for a more energy efficient property. So yeah, I think I will quickly go through some of our results. As in the interest of time, I think we don't have to dig too much deeper, but I think the results are quite clear. Eva, if you could go to the next slide, I think. Yeah, here. So just to briefly explain what we have here. So we have energy performance certificates data for mortgages we've been receiving for about 4 or 5 years now. And here we have data from France and Netherlands. So the top chart is from France and the bottom from Netherlands. And we're just looking at cumulative delinquencies for mortgages for different houses. And they group by, of course, how energy efficient they are. And for the two countries over a period of 48 months. So you don't have to go too much into detail, but I think I can clearly see that the properties that are rated A, B, or C, which we could call they're energy efficient, they are a lot less likely to miss payments than properties that are rated D, E, F, or G. And this holds for both the countries, France and Netherlands here. We use these two countries because these were the two countries for which we had the most data at that time. But clearly, in short, if we just look at the energy efficiency of the property and how often do borrowers miss payments, we clearly saw this differentiation that the energy efficient property borrowers who have energy efficient properties are less likely to miss payments and that's a long enough time series of 48 months as well. If we go a bit further, please, Eva. So, of course, we only looked at the two factors here, of course, the delinquency and the energy efficiency. And of course, there's well-known credit predictors, credit risk predictors that we have as rating agencies also use. And one of them is, of course, for mortgages loan to value. So we, of course, try to dig a bit deeper to make sure is it only the energy efficiency, or of course, if you account for other factors as well, if energy efficiency is still relevant for credit risk. So here we look at OLTV. Again, the top chart is for France and the bottom chart is for Netherlands. So if you group again the mortgages by energy efficiency and you look at the OLTV distribution within each group, you hardly see any difference across different categories. So the OLTV is about the same when you look at the different houses within the different EPC categories. If you dig deeper, of course, you will find slight differences here and there, but not very clear as we can in these charts. If you go to the next chart, please. Next slide, please. Yeah, so one back, please. Debt to income. Perfect. Thank you, Eva. So here we are looking at another predictor of credit risk is debt to income ratio. So your debt compared to your income. Here again, we hardly see any difference. Arguably for the top chart, which is for France, for the A category, you could argue maybe banks are willing, when they originate loans, they're willing to take on slightly more risk. So debt is a bit larger compared to the income when borrowers get a loan for a house which is rated A. That's for France. And for Netherlands, the rest, I think you hardly see any difference. So yeah, so when you look at OLTV, debt to income, and I think there's one more. If you could go to the next slide, please. Perfect. So this now installment to income. Perfect. Thank you. So here again, we see the installment compared to the income for the EPCA category for France, which is the top chart and the first bar. You see there's might be a slightly higher than average size of the installment compared to the income when we look at France. But other than that, you hardly see any difference across the other EPC, so mortgages for different EPCs there. So in short, I think, so you can see that cumulative delinquencies for energy efficient houses are lower. Even if you look at the distribution of typical credit risk predictors, OLTV and debt to income, installment to income, there's not much differences across different if energy efficiency properties, how energy efficient the property is or not. If we can go to the next slide, please. Yeah, here when you start seeing clear differences across houses that are energy efficient or not, or the mortgages for houses that are energy efficient or not. So here we have grouped borrowers by their income, again for France and Netherlands. And we see the distribution of how energy efficient the properties are within those groups of borrowers. We clearly see the higher the incomes are, the higher the percentage of, energy efficient properties for those borrowers, which arguably makes sense as well, because of course we know energy efficient properties on average are more expensive. So of course you need a higher down payment probably to actually be able to afford the mortgage, and then further on, of course, to be able to pay the regular monthly payments. So, but for both the countries, Netherlands and France, it's very clear that the higher the income of the borrower, the more likely he is to go for a more energy efficient property, and it's like keeps going up in steps. So there's a very clear indication there. If you can go to the next slide, please. Eva, if you can. Perfect, thank you. Here the picture is a bit flipped. So within the house, within the category of the same energy efficiency, how does the breakdown of different borrowers by income look like? Here again, maybe it's not very clear in this chart, but it's kind of a similar trend. So the more energy efficient the property is, the higher the income would be. If you can go to the next slide again. Okay, income was, yeah, perfect. Thank you. Yeah, great. So here we have, so the very first chart we showed was on cumulative delinquencies, and that was purely based on energy efficiency. Now, as we know that, of course, the income is something that it's different across different houses, properties, especially when in terms of energy efficiency. So we tried to control for the income here. So the top chart you have is for the cumulative delinquencies in France for borrowers who have income up to 40,000 euros, and the bottom one is 40 to 80. I won't go into too much detail because there's a slide that summarizes this, but in short, you see the more efficient the property is even within an income threshold, and you still see the relationship holding. If we can go to the next slide, please. Eva, next slide, please. Perfect, thank you. Yeah, this is the interesting one, because for France, it turns out if you look at only the borrowers with an income of 80,000 and above, the relationship doesn't really hold. We still don't know why. Maybe it's just because the sample set is a bit unique for some reason. We haven't figured that out yet. But in short, the energy efficiency as a predictor of delinquencies, the relationship doesn't seem to hold anymore if you look at borrowers who have an income of 80,000 or more. It could be different things. We also know that there are borrowers who have very high income, often have more than one property. So it's probably that as well, but to be honest, we don't know yet. If we can, so we have the same three charts for Netherlands now. I think we can quickly skip that. And if you can go and one further. So in short here, so the cumulative delinquency line charts that you saw for France and Netherlands. So here, this is in these two tables, you have that result summarized. So in the interest of time, I think we can just look at that. If you again look at France, if you look at the income category 10K to 40K, and then the different EPCs overall, the cumulative delinquencies, this is at 48 months for these mortgages. You clearly see the higher within the same income category, the less efficient the property is, the higher the cumulative delinquencies become. I mean, of course, it does hold kind of in most of the cases, but the trend is clearly there. The France for 80K or more is the one we had a look at, which maybe didn't make too much sense, but maybe there's some explanation to it. We don't know yet. But if you look at all income categories in general, the relationship clearly seems to hold. So properties that are A, B, C have lower cumulative delinquency in the properties from D to G. And if you look at Netherlands, it's still kind of there. I mean, you guys probably already know as well that the way EPCs are assigned to houses in different European countries, the thresholds can be significantly different. And Netherlands is one of the countries where the thresholds even have categories A plus and A plus plus in quite a few of them, and then which means that you could have the same house in Netherlands and the same house in Germany, and it might be rated A in Netherlands and might be rated D or C in Germany. So of course, these thresholds, of course, can also have an impact on some of our results, but nevertheless, because the relationship is linear, so I mean, even within the country, if the thresholds are different, a property rated A is always more efficient than a property rated B. So I think these results, especially the direction of it, should definitely hold, even though the thresholds are different in the two countries. Yeah, I think yeah, that should be more than enough. I think if so, in short, we clearly see that cumulative delinquencies are lower for more energy efficient houses, even if you control for income. I have one more chart, but I think that the gist of it is already I have presented. So if I don't want to take much of your time, thank you so much for your attention, and please, if there's any questions.
Thank you very much, Usman. I mean, it was really, I think this is a very important debate. As everyone knows, the European Mortgage Federation is having an entire initiative aimed to deep knowledge on this topic, which is the Energy Efficiency Mortgage Initiative. And under this umbrella, we are running a new European project called Deliverem. We will do more study on this together with the university. We are asking all the banks to provide the data on their portfolio. So we really want to achieve a refreshing of the study that has been done under the EDAP project, which was done also with the European Data Warehouse. And we want to deliver more information, not only about the correlation between energy efficiency and credit risk, but also we are trying to see if there is any causality between these two elements. So stay tuned, watch this space, because more information will be coming. Thank you very much, Usman, and thank you very much to Data Warehouse for their strong support to our activities. With this, allow me to move to the rating agencies sector. I mean, Susanne, you will be the first one in line. I mean, I think we start with Fitch with a nice overview of what you see in the mortgage market. It's a bumpy road. We all know it was a difficult year, but what is in front of us? Thank you, Susanne, for being with us, and thank you also, Davide, for the support that you're giving to us.
Yeah, thank you, Luca. I think I will take the start, and Susanne will come up later. But yeah, so let me start. So good morning, everyone, and thank you very much for the invitation. So in the interest of time, we would like to focus on some of the main points about the European housing and mortgage market, rather than diving into the details and numbers of our article. But we're happy to answer questions during the Q&A, and feel free to reach out to us for more information. Just maybe a quick clarification before starting. The forecasts we are discussing in our presentation are from the Global Housing and Mortgage Outlook 2024 media update, which was published in June, with the GHMO for 2025, which is coming out soon. With new forecasts. So yeah, if we can move to the first slide. Yeah, so for the year end 2024, we expected modest home price growth across most of European countries, and year-to-date numbers are start aligning with these expectations, and we expect a slightly higher growth for 2025 in some markets, but there are a few exceptions. In France, home prices are expected to decrease in 2025, and in June we have revised home price forecasts for Spain and the Netherlands upwards from the original forecast of December due to stronger demand and economic resilience. The UK year-to-date growth is notably higher than expected, though this increase is partially due to the technical reason on how the index is calculated, and we think that the official figure will come down a bit. We still likely to underestimate the growth for 2024. And if we can move to the next slide, when we looking at this chart is looking at the home price growth evolution and the forecast, and there are a few things that we would like to point out here. So the first is that despite a fairly similar environments over the last couple of years, was characterized by high mortgage rates, rising cost of living with GDP, but with fairly stable unemployment rates, home prices have reacted quite differently in the European countries in our report, with the Netherlands that has been the housing market with the strongest home price growth over the past year. It's approximately 10% year to date, and we expect these to remain robust also going into 2025. The drivers include significant wage growth and a persistent housing supply shortage. And by contrast, we have France, which is the only market where we expected a decline in home price by 2 to 4% in 2024, and we expect this decline to continue also going in 2025. The decline is due to stricter affordability limits for France, reduced demand, and lower home buyer confidence. The other country which is notable is also UK, which has shown remarkable resilience to interest rate shocks, and passing the peak of the rates has benefit demand, while the sale numbers have still been low. And for the other countries in our report, we had forecast maximum 3%, with the only exception of Spain, which is up to 5%. And for the 2025, we don't expect. We have not expected major increases. So if we move to the next slide on the mortgage rates, this is one of the major topic of our report. So in 2024, we expected mortgage rates to stabilize or peak, but to stay at high level, and this has occurred. Like in the first graph, we can see how the new mortgage rate rose quickly across the market starting from 2022, with changes in policy rate having the largest impact on new mortgage rates. But high rates on new mortgage and rising cost of living, including rents, have affected what potentially first-time buyers can borrow and afford, and have kept down demand. The interesting element is the transmission from policy rates and new mortgage rates to average outstanding mortgage rates, because these have varied much more, as we can see in the second chart. So we have long-term fixed rate markets like Germany, the Netherlands, and France that have seen the stock of mortgages facing only a limited increase. And in contrast, in other countries, we have with a significant proportion of floating rate mortgages like Spain, Italy, and the UK, which has short-term fixed mortgages. The curves show much larger impact on the stock of mortgages for these specific countries. And if we can move to the next slide on the mortgage areas,
Davide, can I ask you a question?
There is a link. If you can move to the next slide, please, Eva. Yeah. In any case, so if we look at the mortgage areas, the picture of performance data is, could we move to the next slide, please? Okay, thank you. So what I wanted to say about this is that when we look at the picture of the performance data, this is reflective of mortgage interest rates. So for countries with a large exposure to floating rate market, or countries with short refixes, these are the one where we projected the highest increases in arrears. But considering the magnitude of this change, the arrears level have been overall quite stable, and the increases are from historically very low levels. So overall, we expected a modest rise in mortgage arrears in 2024, with stability or slight decrease in 2025. And if we can move to the next slide, we can take a look at the evolution of arrears over time. And together with our forecast, we see that the level of arrears in absolute terms is quite low. But relatively, European countries, like, as I said, with significant exposure to floating rate or shorter refixes, see higher increase in arrears. But generally, arrears are expected to remain low due to supportive measures like borrower equity, and servicers are deploying forbearance measures for borrowers, and mostly the unemployment rates are stable. So there are pockets of risk that we keep monitoring, especially those weaker borrowers, such as first-time buyer, high LTV borrowers, and those one that experience payments shock due to remortgage at higher rates. So these are the one we keep monitoring, keep an eye on, and I think with these I will hand over to Suzanne, who will cover the outlook and the conclusion of our presentation.
Suzanne, can I ask a
sure.
question to
Sure.
Davide? Davide, I see the European Commission raising a question, I think, on Luxembourg in the chat, asking if you have information about an expectation and any forecast on the Luxembourg housing pricing. Because seems to be that the Luxembourg is a bit an outliner. So I don't know if you can see the question in the chat, and if you can try to give some kind of information. Yeah, sorry.
Yeah, sorry. I can answer, because actually unfortunately we don't have a view on Luxembourg that we can share today. Apologies for that. But we cover 15 countries overall in the Global Housing Mortgage Outlook report, which arguably as part of the globe is maybe not that large a percentage, but is covers really what our key markets that we work on. Either for cover bond or RMBS ratings. So we also want to comment on markets that we work in, that we have an opinion on. So that's why it is limited to those 15 countries.
Thanks, Suzanne.
Great. Great. So if we could just go to the next slide. Okay, so the first thing really just wanted to mention is that our next full report is coming out in about a week and a half. That covers the 15 countries. It also comes out just after the latest update from our economics team. So it also considers all of our latest macro forecasts. You can get it from our website. If you have any problems with that, just contact Davide or me, and we can help you with that as well. But looking ahead, for European markets, we continue to expect mainly modest home price growth in 2025, and we see often similar drivers to 2024. So, for example, it's more positive for buyer sentiment to be past the peak of mortgage arrears than before it. This gives buyers a bit more confidence and potentially increases what they can borrow. Plus, we expect some support from wage inflation and growing household numbers in certain countries, but we don't expect a major step up in demand. And this is mainly because while we see mortgage rates falling, we think this will occur only slowly. Also, we don't expect major changes on the supply side. This tends to be a slower moving area generally. There are some ambitious government programs in some of the countries we cover, but these are quite difficult to achieve in an environment of high costs and insufficient labor. So we don't expect really a notable short-term impact on the supply side. Finally, I don't think you'd be surprised by the comment that there's potentially more downside than upside risks. There's a lot of uncertainty related to what actions the Trump administration will enact, and also the ones they do enact, what order, what speed they will do them. So there's a lot of uncertainty on this side. And it's really hard to see, sorry. So this is why we're seeing, more downside than upside risks for the European markets. What is unique in this situation, because I've worked on this report for many years, is that really one election could cause volatility for all 15 countries we cover. So this will certainly be an area that we're focusing on a lot next year. And yeah, we didn't want to take too long. So these are really the highlights that we wanted to raise today. I unfortunately have to leave in 23 minutes, but if we get to the Q&A before that, I'm very happy to take part, or please contact me with any questions afterwards. For the countries the European countries are also the global countries where we're happy to discuss.
Thank you, Suzanne. I mean, unfortunately, I don't think we will make it in 23 minutes because we have still 2 presentations to go. But thank you very much for this, for the outlook. I mean, I think it's very important, and we will stay tuned. I mean, in the sense that your contribution was very important. Housing will be extremely important. As the commissioner said, I have only 3 important things on my desk: housing, housing, housing. So this will remain the topic of the year. So I mean, a big welcome to Alexander. I mean, I have to say you were very brave, because that was the topic of the discussion behind the scenes last year. And we asked you, are you so brave to tackle this issue? And you said yes. So thank you very much for jumping on this chariot, Alexander. And I give you the floor. And please give us an overview of what's going on the commercial side of the story. Thank you.
Perfect. Well, thank you very much, Luca, for inviting us today. I will really speak about the wider CRE market, because I think now that's really where the action is. But that being said, I think let's keep in mind that within the wider CRE market, the CRE covered bonds, that's really the section with the lowest credit risk, right? So let's get started. Maybe on the next slide. There are really two messages that we want to convey. The first view is that the refinancing risk, within the CRE lending, we think that will crystallize over the next couple of years, because that's the time when the peak cycle loans that they will mature. So these loans that have been originated in 21, 22, that's what we call the peak cycle loans, and I will show you why. So they will mature, and really what that will lead to is, in our view, is a bifurcation of the CRE market. So that's number one, and then number two, when we shift our view a bit to the new CRE loans, there we actually think that they are much less risky than what we have seen in these peak area loans. So maybe on the next slide to dive into it. Eva, if you can go to the next slide, maybe. Perfect. Thank you. Yeah, that's perfect. So let me first set the scene a bit to give you an overview what our expectations are really. So number one, in terms of policy rates, so short-term rates, we expect them to fall next year. But maybe more importantly, the long-term rates, they will stay higher for longer. And that really means at the end of the day that there's little respite for CRE values. Now, and in this environment, this really adds to the existing structural headwinds now that we have seen, and here it's really about the office and the retail sector where there's a lack of demand. Now, secondly, we think that the funding conditions are tight, but we also need to set this into context, right? So we don't think there's a credit crunch. So this is not 2007 or 2008. But what we do see is that now banks are quite selective in their lending. And in the last few weeks, and maybe more importantly also for next year, we think that the lending conditions they will ease a bit. So a little bit of relief for borrowers. Clearly, when it comes to the outcomes, the refinancing default risk is really what determines and the outcomes. And here I have in particular in mind these large ticket size lending, which are now interest-only loans, maybe over 3 or 5 years. That's where the refinancing default risk dominates. If you have other situations in different cover bonds, different cover pools, maybe, for example, longer-term amortizing loans, then obviously that's a different situation. Now, why is the refinancing risk so important? It's really because, number 3, during the term, what's more important is the operating performance, and that is actually quite robust. Now, that being said, there are clearly some asset classes which are under pressure, and non-prime office comes to mind here. It's maybe also worth differentiating here between Europe and the US. When we look, for example, at vacancy rates, in Europe, the vacancy rates are roughly 10%. Obviously, there are differences across the markets, but roughly 10%. And in the US, they are 20%. So overall, we think Europe is in a better place in the CRE markets than the US right now. Now, what's the consequence of all of this? The consequence is this bifurcation of the lending books. And that simply means that as the loans come up for refinancing, some sponsors, they will survive, meaning they will be able and willing to support the programs with equity. And other sponsors, they will fail. And here we should keep in mind that much of the CRE lending is on a non-recourse basis, right? So it's also a question of the willingness of borrowers to support their deals. Here again, it's important to keep in mind that covered bonds, as I said before, is the lowest risk section. And that is really because we expect that issuers will maintain their cover pools at a very high quality level. And that, I think, provides us with a lot of comfort. In terms of the downside risks, okay, so what could go wrong? Well, much tighter bank funding could be one problem, and or an increased selling from large CRE funds, because that could trigger a downward spiral. It's not our central scenario, but it's clear downside risk. And then what's the wild card? Well, that's private credit, because here we have a lack of transparency in terms of the lending book, but also in terms of the lending behavior. So that was kind of to set the scene. Maybe on the next slide, Eva. Yeah, great. If I just can give an overview about where we are in the property cycle. So here the top line that shows you the CRE market yield that's consolidated across different property types, different markets in Europe. But what you see at the right hand, you see that the market correction has taken place over the last 2 years. And you see that market yields are now much closer to their long-term averages. And also when we look at the blue shaded area, that's the CRE risk premium, there you also see that it was quite compressed a few years ago. Compressed is for us like a warning signal, really, and now has returned to more levels which are more in tune, really, with the longer term averages. Now that's where we are in the property cycle. Maybe let's speak a bit about how that affects our analysis on the next slide. Thank you. Perfect. Yeah. So here you really see how we reflect all of this in our analysis. Basically, we do this via haircuts. Now, these haircuts, they have really increased early on and are now again on a downward trend. What's the effect? Maybe just as a background. So what happens is we receive market values from the banks, from the issue of the covered bonds, and then we apply a haircut to this market value depending on where we think we are in the property cycle. And what you see on the chart on the left is that these haircuts have really increased early on. So we increased them basically for the last 10 years. As the bubble built, we basically increased the haircuts, and they peaked in 22 at around 25 to 30%. Obviously, again, different by markets. That is consolidated numbers here. But you clearly see that we early on increased the haircuts up to 22 in the peak. And then on the right, you see what actually happened. And you see here that since 22, the prices have actually then fallen by around 20 to 30%. So that's where we are then today. On the next slide, maybe thinking a bit more about covered bonds. Because now if you have established that we have peak cycle loans, which are clearly more risky, the question is, well, what's the exposure of covered bonds to them? And that's the chart on the left. So here you see a breakdown of the cover pools of the largest CRE programs, a breakdown by the years of origination. And when we look at it on the left, you see that overall, actually quite a few of the pools, they have well-seasoned loans, which are much safer because there the properties had time to build up equity. And the exposures to the peak cycle, so years 21 and 22 are around 10, maybe 15%. So on a total basis, it's not too bad. But on the right side, you see that there are some riskier outliers. So here we look at which programs have the highest or the lowest exposures. to these peak cycle loans. And you see that there are some programs that have 45–50% of exposure to the peak, which is clearly more risky, and that's obviously a driver in our analysis. Let's go to the next slide just to speak about the second topic. So these are about the new CRE loans. As I said before, we think they are actually much less risky than the debt originated back in 2022. And that's really what this heat map here illustrates to you. So here you see the different years, and you see different markets. And basically, when we look at 24, what we see is that much more markets are now in the green territory. Not all of them, but the majority. And overall, I think across the ranges, across the market, it's true to say that we are now in a better place than we have been back in 22. And therefore, we really expect that the losses that we see for loans that were originated this year will be significantly less compared to the quite high losses that we actually expect for the loans from 22. And maybe then on the next slide, just to bring it to a conclusion. So here, that's our outlook for 25. We think that the conditions are improving slightly to a neutral level from a clearly unfavorable level. That was the case, especially last year, but also partly this year. So on the left side, you see the situation in Europe. On the right, you see it for the US. Maybe if you start on the left. So Germany, France, Italy, Spain, and the UK. These are kind of some of the main markets. What do we see? Well, we see really that Germany is a bit of an outlier on the CRE market, where the situation 24 is still unfavorable, while in the other European countries, it has already been in the neutral level. But maybe forward-looking, we think that next year these 5 markets will be in the neutral territory. And underneath, you see the underlying drivers that really determine the overall view. When we compare it with the right, in the US, slightly more unfavorable, but also on a stabilizing outlook. I think in the US, it's worth keeping in mind that the office sector is in a different situation. And maybe if I draw your attention to the chart at the right, at the bottom right, when we look here at this purple line, so the office area, basically what we see is really that in the US, the office market is, in our view at least, now in a situation that is actually worse than it was back in the great financial crisis. So quite severe. That being said, for next year, we also expect it to improve. So to summarize, overall, I think we are not out of the woods yet. But at least the central scenario is that things are no longer deteriorating much, but they will stabilize. And very happy to take any questions later on. Thank you very much.
Thank you, Alexander. It was really impressive to have all these details about the commercial real estate. I think that were questions coming from all over stakeholders. I mean, journalists, commission, that were given. So this overview was amazing, and I really recommend everyone to read very carefully the chapter that we have in Hypostat. Allow me, before moving to Antonio on the global side, I would like just to draw some conclusion, and that's my personal view, of course, and I would like to recall that I'm absolutely partisan because I represent the mortgage industry. But the key question that we receive from journalists, is the Mortgage Credit Directive been a success or not? I think that we have to draw some kind of conclusion. It was a very difficult journey where the Mortgage Credit Directive, I think, has maintained in a very balanced equilibrium between national specificities and also building a single market. So consumers had with the Mortgage Credit Directive similar approaches on how they could have access to mortgages, which is the most important social lift in our society. And also the financing of these mortgages in capital markets via the Covered Bond Directive, via other instruments, has been really, really important. Let's look at what happened since we implemented the Mortgage Credit Directive. We had very difficult crises, sovereign crisis, we have seen COVID, we have seen a geopolitical crisis, and the mortgage market has been able to manage high interest rate, very low interest rate, and provided millions of mortgages to all the citizens in a very similar way, from Estonia to Spain, from Ireland to Greece. This is a success. And I think that we have to praise the good work that the European Commission has been doing on the Mortgage Credit Directive. This will be probably a topic in the next Commission, but we have to draw the conclusion, and it worked. It worked very nicely as giving opportunity, values, consumer protection to most of the European countries. That's an important achievement that we wanted to underline here, and we want to start the discussion on this topic on the strong basis that the market has done the homeworks, the European Commission has done a very solid legislative framework, and we want to work on this. We have also allowed innovation. We see the number of green mortgages, ESG information, data access, and the digital deals that we see. So innovation was absolutely allowed by that framework, legislative framework. That's an important achievement, and we want to underline this before moving to the global perspective. And Antonio, with this kind of introduction of strong support of the work that has been done by the market, by the regulators under the Mortgage Credit Directive, we want to give a look of what is happening outside of the European Union. Thank you very much.
Yeah, thank you, Luca. Antonio Farima, I'm a credit analyst at S&P Global Rating, covered bond team, also a member of the ECBC's Global Issues Working Group. And as such, during the year, we have a lot of conversation with market participants regarding the development of covered bond markets outside Europe, how they can help the funding of mortgages, and how better to approach this. And we see that many countries are looking at covered bonds, even if they have not yet fully developed capital markets. And so we focus our attention for this article on this, the relation between covered bonds and the larger, wider capital market development. Together with my co-author Marta Escutia, is also an analyst at S&P Global Rating. We look first at the literature and the empirical evidence regarding the condition to develop capital markets. And we see that generally there is a consensus that you need a stable macroeconomic environment. Growing GDP, for example, will help the funding to create funding needs, but also the creation of saving that can be deployed, the formation of assets. Also, other condition is certain development in financial market, especially the banking sector, tend to be the first point of call for the origination of assets. And also investor, we look at the experience of banking originating and managing asset to decide whether or not to invest in a new country. And also very important to have a stable and strong legal and institutional framework, again, to provide some comfort to investors that they will have their money back, that there are not legal constraints to this, and that the story is more a credit rather than a legal story. And together with that, we saw that there is generally development in capital market funding. At the initial stage is the government that is the main issuer. And so initially we have government debts, and we have as an investor mainly domestic banks. And then as a capital market develop, we have companies and banks that are joining the government. It's still mainly a domestic market. We may have more investors, such as asset managers, such as insurances, but we are still in a growing phase when the markets are developing, but are not able to fully meet the funding needs of the economy and the society. In order to do that, there's a need to grow in efficiency, scale, liquidity, attract foreign investor, attract a new investor. And many times countries are not able to move to this third and more mature stage of development. So our insight is that covered bonds may help this development, may help to move to this third stage. We see in a lot of countries outside Europe that have developed covered bond markets, the like of Canada, Australia, Singapore. These arguably are very established capital markets. They develop covered bond in a very established capital market. So we think that we should not draw the wrong conclusion for that. We shouldn't draw the conclusion that you can have covered bonds also only to the extent that your capital markets are already developed. It's obviously easier to do that in that environment, but the key insight of our publication is that you can and you should consider developing covered bond even when you're in intermediate stage, when you still have mainly domestic capital markets. You can do that. We have a successful example in Central Eastern Europe. More recently, we have a successful example in Brazil. But the insight is that this development of covered bond initially as a domestic issuance can also be very helpful to move to the next and following last stage of development of capital market. And this is because covered bonds will help banks to develop a track record. So in Brazil, for example, a foreign investor will see that covered bond work well domestically. It will be easier for them to get a credit line if and when they want to issue internationally. It will help to gain scale because the issuance of covered bond will help Mark to redeploy the proceeds from the covered bond issuance to originate more mortgages and create a mass of asset that can be used for foreign issuance. Can help in terms of transparency because we know that covered bond many times come with initiatives such as the harmonized transparency template that we know offer a lot of comfort to investors that want to take a view on a new pool, a new investor, a new markets. And also will help the development of tools such as derivatives that are also consideration that are important for investor. And also, and finally, we know that importantly, covered bond can have a higher rating than the Asian bank, but also the sovereign. That is also an important consideration for many investors. So there is much more detail in the article, and we're running out of time. But yeah, if there is a key message is that as a policy maker need to prioritize many things, especially as they are developing capital markets. They shouldn't consider covered bonds only in a very mature stage. The covered bond should consider earlier as they can help them move capital markets towards a more sophisticated phase. And with this, Luca, I will hand it back to you.
Well, thank you very much, Antonio. And of course, we continue our work in a lot of countries. So you say Brazil. I mean, looking at the numbers of Brazil is quite impressive. I mean, we have more than 20 billion of covered bonds outstanding there. So it was a market created from scratch and is helping the banks in managing access to capital markets, reducing reliance on deposit, and be more supportive of the middle class, because at the end of the story, this is what we are doing. We try to implement covered bonds in other countries. We are currently in discussion in several countries around the globe, and we support the World Bank, IFC, and other institutions in trying to improve capital markets. In this spirit, we would like to say that we just published our response to the securitization consultation of the European Commission. So if you are curious to see our position, please go on our website. It will be available on the position paper section, where we can see the paper prepared by our organization as a response to the consultation of the securitization debate here in Europe. With this, I would like to open a question and answer session. Our authors are here with us. Just to double check, I know that Susanna had to leave, but I mean, I don't know, Davide, you are still with us?
Yeah, yeah.
Perfect.
Hope you can hear me now.
Yeah, perfect.
Sorry, I had a small issue with that.
By the way, I mean, Desi, you are from Sardinia, yeah? I mean, Desi is from Cagliari.
Sorry, Luca, I cannot hear you.
Sorry for this. You know, it was a silly question if you were from Sardinia. I mean, with that family name, I mean, Desi, it's very...
Okay, let me try to leave. I will connect again.
Okay, fine. It was a silly question, no worries. The question is, well, I mean, allow me to open the floor. Please don't be shy, you know. I know that it's Friday. It's almost lunchtime in Brussels, but I mean...
Okay, if everyone else is going to be shy, I'll go first if I can.
Thank you, Richard. We know that we can count on you.
Now, reading Hypostat this year, one of the things that was really striking is the debate about fixed or floating mortgages and countries going in opposite directions. Poland has gone from being an entirely floating rate mortgage to having a substantial fixed rate. Sweden, it's going the other way around. They're having more floating rates, even though they had an inverted yield curve there, I think. And I think there have been a couple of things recently have gone to commission. Jenny just forwarded me something by Finance Watch, which was clearly advocating for everyone having a fixed rate mortgage. And you mentioned, and Julia mentioned, and a couple of other speakers mentioned this topic. There is no right or wrong answer. It feels like we need to have a sensible discussion about the relative merits of fixed and floating rate mortgages in different countries. And I'm just concerned that there's a lot of advocacies like Finance Watch, like the Tony Blair Institute, who recently published on this topic, pushing their particular agenda as gospel truth. And I think it's fairly clear from the diversity of opinions in Europe on the appropriateness that we need to have a broader discussion rather than pushing fixed rate at best or floating rate at best. It's an observation rather than a question.
Well, allow me to pick up on this point because it's a very philosophical point. I think that the spirit of the Mortgage Credit Directive, and I speak under the control of Gintaras, it was to allow the market to be free, to offer the best possible portfolio of product and allow the citizens to select the best possible instrument for their needs. And I think we achieved this level in the sense that, I mean, we can have variable rates, we can have fixed rate, different market. Also, there is a debate about what does it mean fixed rate? You know, I mean, exactly what does it mean? Personally, I think that I found myself very comfortable in the variable rates that allow me to save a lot of money. And I think we took advantage of a very low interest rate scenario in a very convenient way. But this is, I think, up to every single citizens to decide what is the best option. And banks had the chance to build a strong fixed rate market by using long-term funding tool like covered bonds. So most of the market were able to switch in the right moment and offer this portfolio of a fixed rate market and a variable rate. So I think the spirit of the European Union is to live in a free market. And I think to give a richness and depth of the offer of the banks, we see also the banks in growing. Now you can also decide what kind of a color of your mortgage you can have. You can have a green fixed rate mortgages or maybe going for a variable rate. I think that was the spirit of the directive. And I see that, I mean, markets are also switching very rapidly from one characteristic to another. I was, for example, let's look at the Spanish market, how radically they switched to fixed rate mortgages quite rapidly, or other markets like Italy, where, I mean, there were more fixed rate, but people may be less fragile, they decide to take advantage of variable rates. So that is, I think, a very philosophical debate. I'm a bit always scared by this kind of positioning of what is good and what is bad. It depends from the condition, it depends from the borrowers, it depends from the market, it depends what we intend with a fixed rate. This easy political statement and motto, I think, are very dangerous in this landscape. Of course, with the housing debate getting a center stage, everyone is positioning themselves in this kind of, and I think it's important to listen to everyone. But we, as a European mortgage industry, we have to also give clear messages and say the purpose of the Mortgage Credit Directive was to provide depth to the market. And this was achieved. And now every single citizen can decide whatever is more convenient to them in the right moment, in the right decision.
Yeah, I have say a few words. I mean, since you referred to me specifically, so I think one thing is clear. I think I would like to underline the keyword choice, right? Choice for consumers. So that's, I think, where everybody agrees. They should have a choice, and it would be really difficult to advocate for one or the other alternative. The issue that we have, and you mentioned the good examples like in Spain, well, not necessarily good, but okay, there are changes in the market. So the issue is that choice is not everywhere available. You take, well, I think you rightly mentioned that Poland is moving towards, tries to come up with something measure to basically incentivize or provide a choice, also fixed rate mortgages. But certainly the issues in the Baltic states, where basically there is consumers are never offered a fixed mortgage rate. And then the question is, okay, is it because there is no covered bond market? Is it because the market is small, etc.? And what happened, it led to quite drastic measures taken by just recently. I think the law was adopted like last month, which would now require all the mortgage providers to also offer fixed rate mortgage loans to consumer whenever the consumer approaches them. So it's not forcing the consumer to take a fixed rate mortgage, but rather making sure that he's at the same time is offered also a fixed rate mortgage. I don't know yet, I mean, what really all the reasons underlying this practice in the Baltics, but certainly one of the reasons could be linked to the fact that those small markets are largely almost dominated by the Scandinavian banks. So we basically passed the practice, the way we do the issue mortgages in Scandinavian countries, the same way we do in the Baltics. So yeah, the choice. So I just end up here. So it's just the choice is important, and unfortunately, I mean, in practice, I mean, the choice is not yet everywhere. And this is a bit of our concern, so which we will also continue to take a look. And this is what you rightly mentioned, the consumer associations are also worried about.
We are working on this. Sorry, in the sense that, I mean, we have been doing, and Richard have been working quite hard to have a covered bond legislation in the Baltics that is allowing banks to have a critical mass, so they can use the same legislative framework for covered bonds in the three Baltics. We are actually going together with Richard to have meetings with all the Baltics issuers to promote covered bonds, because this can help long-term financing, which at the end of the day is the secret recipe for having fixed rate mortgages. So, Gintaras, just to let you know, we are working on this. The ECBC will be there, full energy, to improve the capacity of every single European citizen to have a right set of options. Sorry, Richard. I mean,
no. My point was only, I think we all agree that we want choice, and we want people to be able to make that decision themselves. It's just I see some people advocating for one solution is better and trying to persuade. I know, some form of incentive package in particular for fixed rate mortgages, the Finance Watch paper or the Tony Blair Institute paper, and I'm just concerned that only those voices are being heard.
Yeah, Yula, I see you would like to step in.
I just wanted to add to this issue, because I've been following for a long time this issue of fixed versus variable, and in some of the Eastern countries we have gone through a very how to say, we could learn from the market reactions that there is the choice and there is also the responsibility, which I would underline from the part of the mortgage lenders, because it's a long story. We had these foreign currency loans. This is thanks God this is over. But we had a very high volatility in interest rates. As in my presentation, you have seen that East Europe mortgage rates are on the higher side. And in this sense, I am a little bit more for the fixed rate. Of course, I fully agree that there should be the choice for the customer. But in Hungary, already 2-3 years before the rates started to grow, there was a strong tendency to go into the fixed rate mortgages, and also this was supported by the mortgage banks who are financing now an important part of the mortgages in Hungary. So there were years, especially 2022-23, we had more than 95% of new mortgages fixed, which helped the customers to overcome this difficult situation. And I think the other thing is, of course, that if your mortgage is funded by covered bonds, then you have the choice also to have the customer to choose between the two options. But I fully agree with Richard that this is an evergreen topic, like what was first, the chicken or the egg? So variable or fixed, there are arguments for both. But I am a little bit in favor of the fixed now.
Okay. Any other views on this debate? I mean, I think it will be probably the debate for the next couple of years, I mean, in our industry. If not, I mean, I would like just to give you also an overview of what we are planning for next year. I mean, as ECBC, we are trying to propose you a kind of busy agenda for next year. Let's start. I mean, of course, in January, we are supporting the CE conference of Inviso. So we will have a covered bond roundtable in Vienna, as we were discussing at the beginning of this event. So if you fancy a nice schnitzel and a lively debate around covered bonds in the region, I mean, that's the place to be. After this, we are organizing a Canadian event. We will be in Toronto to support the Canadian issuers and also to discuss about third-party equivalents. As you know, the European Banking Authority is working now on their response and their position paper on the question raised by the European Commission. We are acting as a bridge among the different countries, making sure that everyone has the same information and there is a massive alignment of best practices and legislative framework around the globe on covered bonds, because we need covered bonds if we want to make fixed rate mortgages. And if we want to make fixed rate mortgages, we have the need of a massive investor covered bond community, and we are building an international investor community to support this market. Then in March, at the beginning of March, we will be in Singapore, our usual Asian Symposium event, and around this event we are organizing also an ISMA event in Manila, because housing debate is a global problem, and we are acting with all the mortgage refinancing company that will be tackling financing of mortgages in international markets, and we want to give a capital markets package very much aligned with the Capital Markets Union best practices and the Banking Union best practices. So we want to make Europe important and global relevant by expanding our best practices. After this, we invite all of you to join us in Athens for the plenary meeting, which will take place on the 29th and 30th of April in Athens. And a big thank you to all the Greek banks who are supporting our event. I think this will be an important gathering. We will be discussing the agenda of the European Commission. As you know, the commissioner are getting in their offices those days. You see them going around in Brussels. They are establishing their cabinet and they will be full operational. So the meeting in April will be really the moment where the industry will position themselves on important discussion like housing, affordability, sustainability. Then we are organizing together with the World Bank their annual meeting on housing. This will take place in Washington at the end of June. It will be at the 30th of June and the 1st of April. So we really invite you to come to Washington and support the agenda of the World Bank, who is doing an incredible work to promote housing at a global level. In September, as usual, that will be the event of the year. We will be in Seville, in Spain, on the 18th and 19th of September, next to Inviso, and we thank Inviso for their support. And this will be the opportunity to really meet the entire covered bond community. We are expecting more than 1,400 people joining us in Seville. Then we will surprise you with more events, but I mean, I don't want to spoil, but we are thinking of doing something here in Brussels in November for supporting the agenda of housing and see where we are in the debate with the mortgage credit directive and see where we are with this idea of this omnibus directive covering transversally all the sustainability directives that have been published in the past. First and foremost, taxonomy. So stay tuned. Be assured that there is a team in Brussels taking good care of you. And if we don't see each other, we wish you Merry Christmas to you, to your family. And some of you, I'm sure, that are taking some extra holidays in December to try to have some relaxed time. So enjoy your time back home. Thank you all.
Thank you.
And see you soon.
Thank you very much.
Thank you.